Well, good evening to all of you that are in our audience tonight. We are very, very fortunate to have two people talking to us about financial planning, particularly for graduate students and what you should be thinking about perhaps now as you look to the future and life after graduate school. So I'm going to just give a brief introduction and then I will turn it over to them. And I ask that as they go through their information, that you all take advantage of our Q&A feature that you'll see in your toolbar, for your Zoom toolbar. You can post questions during their presentation, although they will probably wait and answer them at the end. But to go ahead and get a jump start on questioning, and that'll be perfect. So tonight we have Osmar Garcia. And Osmar, I believe that Jose told me that you graduated from UCA. Is that correct?
I did. Yeah. Go Bears.
Awesome. So Osmar is the CEO and co-founder of Garcia Wealth Management through Northwestern Mutual. So we're thrilled to have him here, and he'll be sharing some insights into his work and what he's learned and how that helps you all. And then we also have Cynthia Burleson, who is a faculty member at UCA and is the Director for Insurance and Risk Management at UCA. So very glad to have you both. And I'm just going to turn it over to you all. And there you go.
All right. Well, welcome, everybody. I'm definitely excited to be here today, especially, giving back to my alma mater. I love UCA. I love the work that, the staff and all the faculty do. So just so happy to be here. And hopefully I can share with you a few things that you'll be able to take with you and implement it in your own life as you continue to grow in your careers. So yeah, thank you for the introduction, Angela. My brother and I, actually, Gilberto Garcia, he was also a UCA Bear and played football there, started Garcia Wealth Management through Northwestern Mutual. And, we service clients that are business owners, retirees, medical professionals, and some pro athletes. So it's been kind of cool getting into that market space as well. So today I'm going to share with you kind of the strategy that we take with clients, because again, it's going to be completely relevant to you all. And before I get started on that, I just want to set the tone for the 4 principles of planning, financial planning, that we follow with every client. Doesn't matter if a client has $1,000 in a savings account or $1 million in an investment account. We follow the same financial principles. Obviously, we just mold them according to each client. So the first principle that we follow is the risk management principle. And I'll dive deep into that one in just a second. Secondly is cash management. Third is debt reduction. And then fourth is saving and investing money. And so I'm going to share this screen with you so you can see what I'm referring to. And again, this is something that we share with clients. If you see through on the right side of the page here, you're going to notice that on the left, there's both defensive planning and then offensive planning. And financial planning, you always want to look at the defensive side first, and you'll see why here in just a second. The defensive plans have to do with estate planning. Whether you are a 25-year-old, 30-year-old individual, there's always room for some type of estate plan that you might want to implement. Emergency fund savings. What happens if the car breaks down? If you get on and you have a mortgage and or a house and you have to repair AC unit or the roof, you want to have that ready to go. Debt structuring. It's important to understand how to take advantage of debt. Looking at protecting income, looking at protecting your loved ones in the event of a premature death. Later on in life, you're going to have a concern of long-term care, right? Maybe not as big a concern today, but it eventually will be. And then on the offensive side, the top part of the house structure you're seeing has to do with the fun part of financial planning. That is, retirement savings, investing for maybe that second home, making sure that you have diversified within the tax system, things that are, again, more exciting. You're seeing your dollar grow versus seeing it kind of go by the wayside to protect what you've built. So I'm going to start, like I said, with risk management. In this principle, we look at first protecting your income. Protecting your income is arguably the most important part of the financial planning process when you start. Here's why. I'll give you a real life example. I want you to imagine for a second that you're out in the real world, and let's just say your salary is $100,000. I'm going to actually, can you see the calculator? Thumbs up, Angela, Cynthia? Okay.
Yes.
All right. So I want you to think about, you have a salary of $100,000 and you're 30 years old, and perhaps you plan on working all the way until you are 65. So that's 35 years. This is simple math, by the way. I'm not taking into consideration inflation. But let's say you're making $100,000 over a 35-year period. That's $3.5 million. If you become disabled and unable to work, generally your employer is going to provide a 60% long-term disability benefit. And so let's go ahead and take that into consideration. So if you become disabled, you have 60% covered through work, potentially, right? Not always the case, but most of the time. Well, it depends on how you paid for that disability. If it was provided to you, well, that 2.1 is a taxable benefit to you. If you paid for it with after-tax money, it is not taxable to you. So see, little things like that matter. So let's imagine that the employer provided it for you and you're going to be taxed on it. And again, just for sake of simple math, I'm going to assume that over your lifetime, you were in the 20% tax bracket, effective tax bracket. So you would actually end up capturing $1.6 million over that 35-year period. So it goes from 100,000, which net of tax could have been about 80, or now net of tax, it's 48. So the question I have, the moment of realization is, if when you start your career, you go into long-term disability event, and you're no longer able to work, all this time that you spent devoting in your graduate courses, and not to mention the future investments you're going to make in your education, I would argue that it's pretty significant if you were to lose that income, right? And so mathematically, I can prove to you that it makes all the sense in the world to protect your income, not just through your employer, but do your homework and do it outside as well, so that you can maximize your income in the event that were to happen to you. We recommend generally that you protect about 85 to 90% of your income. So that's something that I really want to stress, just how important it is to do, especially when you're first starting out in your career. That's one part of risk management. The second part is setting up some type of estate plan. So depending on your family, situation, whether you are married with kids, potentially down the road, you have grandkids, I think it's always important for you as a young individual to have a simple will and a medical power of attorney. By doing that, you're removing difficult conversations that could be had between your family members, because you have made the decisions ahead of time and you've prepared for what is to happen to your assets. Even if you don't have a significant amount of assets, it's still important to go ahead and protect your estate. As you get older and your assets grow and you have a family and you want to leave a legacy behind, at that point, we want to start considering perhaps a trust. And that in itself gives you another layer of protection in terms of the risk management side. I don't know if some of you have heard of probate before, but if your assets have to go through probate, that's not fun for your family members, where a trust kind of shelters you from that. So it's something that we recommend that you look at further down the road, again, as your assets grow or family becomes more complex. And then two more things under risk management. The next one is family planning. So for example, if you are a husband or wife and you have someone that depends on your income and something happens to you, we want to make sure that you have the right amount of life insurance to leave behind so that the next generation is taken care of. Three variables that we look at is how much debt do you have that your family would need to pay off in the event of a premature death. Sometimes you can get the right amount for just that through work. Sometimes you can't. You want to look outside of work. Secondly, if you have children, would you want their education to be taken care of? So that's another variable that we need to look at. And then lastly, we want to look at income replacement. If your spouse depends on your income, we want to make sure that if you're no longer here, they are still receiving a certain amount per month for a certain period of time. I'll give you an example. I'm going to use my own family as an example here. So let's say that I passed prematurely today. My wife and I have 3 daughters. The oldest is 4. The youngest is a couple of months. And so my wife would need at minimum 25 years of income, or part of my income, so that she could raise our children and be fine for her own retirement, right? So those are little things that you may not think about today, but that matter for the long run. And why am I stressing this today? Life insurance is one of those things that is driven off of your age and your health. I would argue that most of us in this room today are the youngest and the healthiest we're going to be, right? Can't go back in time. So when you're planning for the future, that is an area that you want to take advantage of today and lock in as much insurance as you can so you're prepared for the future. And then the last part of risk management is protecting your assets. Now, my definition of that is a little bit different than probably Cynthia is going to speak about here in just a second. But assets are things like your retirement account, your home, your vehicles, your savings accounts, any liquid assets that you might have, or investment property. When you get older, in 65-year-old range or so, there's a 70% chance that you're going to encounter what's called a long-term care event, right? If you go into a long-term care event, that could be detrimental to your portfolio because you have to spend that down before the state ever covers any type of long-term care expenses. Again, I'm assuming that to this audience that may not be as relevant, but I promise you the older you get, the more relevant that's going to become. Here's a statistic. Today, and it varies from state to state, so I'm going to use a national average. The national long-term care expense average per month is between $5,000 to $6,000 a month. You multiply that times 12 months, that's about $72,000 on the high end. So imagine having a $500,000 investment account and you go into a long-term care event and you're having to draw from that account at the rate of $72,000 a year. What happens to that account? It's eaten up pretty quickly, right? Within 4 or 5 years, it's gone. So you want to make sure that you are protecting that as well through long-term care planning. That can either be done through a trust or through long-term care insurance. So enough about risk management. I've covered enough for you guys to think about and mull on a little bit. But those are some of the first steps that I always advise clients to take. Protect your income, protect the family, set up a basic will and power of attorney. And then as you advance in life, you want to continue to add those other items that I mentioned. Okay, next up is cash management. So we all have a certain amount of cash that comes in and a certain amount of cash that goes out each and every month. That's called budgeting, right? So we want to budget our money in such a way that allows us to save for today spend today and save for tomorrow. Here's an example of a budget that we use with our clients. We follow what's called the 60-20-20 rule. We recommend that on average, it's going to be different for everyone, but on average, you want to spend 60% of your income in things that are essential: your mortgage, your car payment, your cell phone bill, other loan payments that may come about. 20% should be spent in things that are discretionary. So these are your Netflix, Hulu, Amazon Prime subscriptions, going out to the movies, traveling. 20% of your income should go towards that. And then 20% should be used to save for the future, right? So you're budgeting your money properly. 60-20-20, remember that. Now, let's say you fill out this budget and your expenses are $3,000 a month. If you're a young single individual, we recommend that you have or save up to 6 months of your expenses. How do you get there? That may be a daunting number, right? So 3,000 is how much you're spending, and we recommend 6 months. That's $18,000. Divide that 18,000 over a 60-month period, or 5 years. And each month you're going to save that amount into a savings account. Treat it like a bill, right? And so what does that get you in the habit of doing? Saving in perpetuity. That's one of the most important things that people often miss, is just getting used to saving money early on. especially when you go out into your career, your respective career fields, and you start earning, maybe potentially a higher salary than you are today. You're not going to know what to do with that money. And so one of the things that I always recommend is save as much of that as possible, up to 20%. If you can do more, do more. I have some clients, believe it or not, that save about 80% of their income, which is amazing. Now, of course, they're in a different situation, but that's something that's important to do, is just save as much as you can. And then here in a minute, I'm going to talk about what else we can do outside of just putting money in a savings account. But that's it. Cash management. Have a budget. Have an emergency fund. If you are a married individual and both of you are employed outside of the home, we only recommend 3 months. So in the example I gave you earlier, if you're spending about $3,000 a month times 3, that's $9,000 that we would recommend you have. Because if one of you two loses your job or has a short-term, illness, the chances of that happening to both of you are slim. So if one of you is still employed, you have enough in savings to continue to float the household and not have to take a step back in any way. Okay, that is cash management. Third principle, debt reduction. Or, and another word or phrase for this would be debt management. I think we could all agree that, especially in this day and age, debt is almost a necessary evil, right? Some of you may have acquired debt by going to school and getting student loans. I myself was one of those participants. But I see that as an investment, right? You made an investment in your career to go to school and get that degree. So if you have debt, a couple of things that I always like to bring up is this. Well, what's the interest that you're paying on that? If it's anything above 5-6%, let's tackle that a little bit more aggressively. If it's anything below that, maybe not as aggressively, but still keep it on the radar. Paying on the highest interest with the lowest balance is called the avalanche method. And if you follow that, that is the most efficient way of reducing your debt balances and saving the most amount in interest. The avalanche method. I'd encourage you to Google that. You can read more about it. But the principle is, let's say you have 5 loans. You're going to look at those 5 loans and determine which one has the highest interest. Then you're going to look at which one has the lowest balance. And let's say we're going to take an extra $100 a month and put towards that loan. Once you're done paying that loan, you take that $100 plus the original payment you were making towards that loan in the first place. And now let's snowball it to the next highest interest with the lowest balance debt. So now you have 4 loans left, and you keep doing that over and over again. That's one of the most efficient ways of getting rid of loans with high interest. Another option is potentially refinancing those loans. Today, especially working with medical professionals, they get out of medical school and generally have a couple $100,000 to $500,000 in student loans. So sometimes refinancing those makes sense if we're able to capture a lower interest rate. One other topic of discussion that I wanted to bring up is that as a financial advisor, it's hard for me to tell you not to pay off something because it's important to pay off things, right? But one of the things that today, because of the environment we're in, is interesting to think about is the example of a mortgage. So let's assume for a second that you get out into your respective careers and you apply for your first mortgage, and your mortgage is $150,000. And you're able to get that $150,000 secured at 3% interest, which is very feasible today. It's absolutely crazy the way that things are shaken out in the interest rate environment we're in. Okay, 3% of $150,000 is what, $4,500, if I'm doing that math correctly, that you're paying a year. Okay, and this is on a 30-year mortgage. Now, let's imagine that you wanted to pay an extra or do double the payments. Double the payments. So if your payment is, that would be about $1,000 to $1,200 a month. So let's say you wanted to double up on those payments and you did $2,400 a month. We can say that you're going to pay the mortgage in probably less than 15 years, right? Now, what if instead you took that extra $1,200 and you invested it in a, some type of mutual fund that's well diversified, and you were able to obtain over a 10, 15, 20-year period a 6% compounding rate of return, which is very conservative depending on, historical information that we have. Well, at the 15-year mark in the investment account at that rate, you would actually have enough to pay off the loan if you chose to do so at that time. Whereas if you continued to invest at $1,200 until the 30th year, two things would happen. You would no longer have a mortgage, and now you would have a significant amount of wealth because of that investment, assuming you get a 6% compounding rate of return. Now, some years will be higher, some years will be lower. But here's why I bring that up today, is because too often times I see in financial plans the desire to get rid of that quickly. The desire to get rid of debt quickly. And that is okay. There's some emotion to that. But from a mathematical standpoint, because interest rates are so low today, that's not something that necessarily makes the most sense to do. Now, if interest rates go up, let's say now we're paying interest rates of 5, 6, 7, 10%. Yeah, at that point, it's not going to make as much sense to do what I just said. At that point, we'll do the opposite, right? So something to keep in mind, everyone has their own philosophy of how they want to do things, but that's an idea around debt reduction, or around debt management. I cannot wait to hear how many questions you guys are going to have here in just a minute from everything we're discussing. So hopefully you're taking some good notes on this. Moving on to the last part, saving and investing money. I'm going to ask a question. Of course, you don't have to answer it, but I'm just going to ask it, and then you're going to see why I asked it here in just a second. If today I were to give you $1 million loan, and I said, in 30 years, you'll pay me back the $1 million loan that I'm giving you, but I'm not going to tell you what interest rate I'm going to charge you on that loan. I'll tell you the interest rate I'll charge you in 30 years. How many of you would take that loan from me? I hope that not a whole lot of you would take that loan from me. And the reason being is because you don't know what interest rate I'm going to charge you, right? Okay, saving and investing, you've probably heard about investing in the stock market, getting a good rate of return, diversify, find the right stock, all these different things that you hear. But here's the biggest downfall that I've seen in portfolios as we work with clients that are retiring. It's portfolios that do not have tax advantages. So in that example I just gave you, when you contribute towards an account such as a 401k on a pre-tax basis, meaning you have not paid taxes on that contribution, but you will when you withdraw, or into a traditional IRA, or what's another example, a deferred compensation plan, a deferred annuity of some sort. They're good tools to utilize. But when you get to retirement, you don't ever want to be locked up to just one simple asset, right? Because in this example I'm giving you, the person that only does that and gets to retirement, they're now at the mercy of the tax system. And I think we could all say, I don't know what your level of knowledge of taxes is, but do we anticipate taxes are going to go up or down over the next 30 years? Most people are going to say up. The truth is we don't know. But the last thing that you want to do is get to retirement and only have money in assets that will be taxed at the designated bracket then. Because today, brackets are actually lower than they have been in a significant amount of time. So the chances of them being higher in the future is very likely. So when you're saving money for retirement, I want you to think about 3 different areas that you can put your money into. Number 1 is called a tax deferred type strategy. This is what I just mentioned, a traditional IRA, a pre-tax 401k, or a pre-tax 403b if you work for a nonprofit. Things that allow you to get a deduction today. In the future, you will have to pay taxes on that money. And so you need to be mindful when you're going to your employers what options you have. Now, most employers today have an option called a Roth 401k or a Roth 403b, or you probably heard also of a Roth IRA. And so these are accounts that you can actually contribute on an after-tax basis, meaning you pay the taxes today, but when you withdraw in the future, you do not have to pay taxes. So now I want you to think about, you're 65 years old, you get to retirement, and you have two types of assets. One that you pay taxes on and one that you do not. What does that ultimately mean? It means that you can choose which tax bracket you're going to fall under. And if I'm you, I would rather pay taxes on, say, 15%. I would rather pay taxes of 15% versus taxes of 25% when I get to retirement, right? That's 10% savings and not compounds over time. The third bucket is called a taxable bucket. And so these are assets that you can invest in, such as a, let's say, a brokerage account that's non-qualified, perhaps real estate, or if you decide to start up your own business. And at some point, well, let me use numbers. So let's say that you buy a business for $100,000 or a piece of real estate for $100,000 that is for investment purposes, and you sell it in the future. Whatever gain that $100,000 had, you will more than likely have to pay capital gains taxes. Same thing as if you were to invest $100 into a stock, sold it for a higher price, you'll have to pay capital gains taxes. But what these assets allow you to do is to buy, sell, withdraw whenever you want without having to wait until that magic number of retirement, which the other accounts that I mentioned earlier are tied down to, and that's 59.5. So it gives you some flexibility to be able to make a decision from a position of power and say, okay, I might not want to wait till 65. I might want to retire at 55. Well, you have 5 years worth of retirement income in the non-qualified space that you can access until you get to 59.5. So it's something that's important to understand is when you put money back, how long is it going to be locked down for? What are my penalties? What are my fees? What is the actual tax that I'm going to have to be susceptible to at that point? There are a lot of moving pieces. The best advice that I can give you today is to prepare for the future by just simply having Roth money and pre-tax money. That's the basic fundamental two things that I can tell you today. And then as your wealth grows, then add the non-qualified planning to your portfolio. Hopefully I'm not mentioning too many things that you guys don't care about. I hope that helps you, and I'll also will be happy to answer any questions that you have, whether it be today or in the future. And I'll finish by saying this: start early. Start early. Don't wait. If you are able to sign up for a 401k through work, do it, especially if there's a match. If they offer supplemental disability insurance, do it. It's going to protect your income. That's so important. I cannot stress it enough. Get with a professional. If you get out into the workforce and you're doing well in terms of income and you just quite don't know how to do things yourself, hire a professional. Go to an accountant. Ask them about taxation. Those types of questions and strategies today are going to be of significant value to you in the future. So devote some time to that. I can assure you that in 30 years, hopefully you remember this conversation and you'll be thankful that you took the initiative to look into those concepts.